So that's going to be it. I'm going to go over to the forum and answer some questions. This is where I left off at. On the forum, I had a lot of email questions, so I apologize for all that, but we got our way through it. So the next one is from Show Me the Pips. All right, question number one. The topic is implied volatility. Can you please expand on the use of implied volatility when buying put or call options? At what point do you say we are paying too much of a premium in the form of presented implied volatility? Example, only using it as an instrument with implied volatility is below its historical mean of one standard deviation. Is it fair to assume a market with low implied volatility would not ever be traded at a premium in the form of a nearby contract? All right. I can already tell you we're going into deep waters without having me sitting down and actually doing the examples. And I kind of like mentioned this with, I think, two other members. They were asking questions about implied volatility in the options. And I mentioned that it's better for me to actually do the example of buying undervalued implied volatility below the historical volatility options after it's been sorted, because all I'm going to do is create more questions, or I'm not going to satisfy your questions here. Okay, because it's better to just to see me do it. So within a month or so, we're probably going to be doing that breakdown as soon as the market gives us our green light to do so. So please give me the latitude here to just promise you I will get to real examples of using it. But basically, you can go to ivolatility.com and you can get the information from their website on just about every stock symbol out there. The idea of looking for stocks, basically, though, you can look at Investors Business Daily. They have a really generic call to put ratio, like an indicator, and it gives you, that's one of the things I look at first, and I'll show you all that stuff as well. And then once I filter down the stocks that I want to be messing with in terms of buying or basically buying, because I don't really sell options or write options, even though it's the best way to doing it, being consistently profitable. But as a trader, I want to be looking for big moves, buy undervalued options, and have the benefit of leverage on my side. And implied volatility is going to have to be below its historical volatility. And there's different measurements I use for that in different scenarios. And I'll show you what they are, but it's not rocket science. You'll see it's very, very easy. Options can be really complicated. And I messed around with them early on when I first started, and I wasted a lot of time because a lot of it is highly technical and it overcomplicates the market, in my opinion. Okay, it's bad enough you have to know where the market's going to go. Then you have to beat the options pricing model where time decay erases a lot of its value. So that's the reason why it's better to be an option writer, or in other words, sell premium to other traders that want to buy options. You're selling it to them. Okay, so you're writing options. That's the best way to make money. But again, you still can lose your ass if you don't know what you're doing and you do it the wrong way when the market is going to scream against the position you're writing against. Okay, in other words, if you're selling calls in an extremely bullish market environment, you could lose money real bad, real fast. And especially if the option holder wants to exercise, then you're in a pickle. So trust me, I will get to implied volatility, and you're not the only one that said this too. It's just better for me to show you examples, because once you see it, it's the same cookie cutter approach every single time. Nothing deviates from it. It's a very simple approach. Okay, and I'll show you where to get all the information and where to get implied volatility numbers and rankings and all that stuff. And it's all free. It doesn't cost you anything. But the second question you got here is, and that's the reason why I didn't read the rest of your scenario, so don't be offended. It's just I'm not going to be able to satisfy that question yet without having real examples, and when there's a time to be buying options. So you'll see it then. The question number 2, topic is open interest. Reason open interest overlay concept you refer to, was this using the offline print data from CRB that uses a 6-year average, or another service? Or is this interesting tool for tracking smart money unusual options activity whereby volume of options exceeds certain percent of open interest, raising a flag of large pools of money hitting the market? The overlay concept that I refer to for open interest, I'm not sure really what you're asking there. Um, I'm assuming it's the presentation I did in June, and I was using the disclosed services there. It was pricecharts.com and CRB Trader. So um, that's really, I don't even have, there's no secret to it. And any other time I use open interest is off of barchart.com using total volume. Okay. Which I just did that here with the crude oil market. When you're doing bar chart, just use that, not contract volume. Okay. And question number 3, bearish locked and loaded tells on futures contracts. Your advice on ideal setups for commodities has a bullish bias, with you most certainly having mastered the art of identifying a lock to go long. Could you please provide examples of a all ducks in a row bearish position